All right, mate. When you're ready, let's
Yeah,
get underway.
let's do it.
Hi, I'm Tobias Carlisle. This is the Acquirers podcast. My special guest today is Mark Simpson. He's the author of Excellent Investing: How to Build a Winning Portfolio, and the manager of Danger Capital. It's a great name. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hi, Mark. How are you?
Hi, Toby. Great to be here.
Uh,
I'm good, thanks.
Danger Capital, great name. How did you come up with that?
Yeah, well, let me just be clear. I don't run outside capital. I only run my own portfolio. The Danger Capital is a sort of tongue-in-cheek name, mainly because it would generally be a terrible name for a hedge fund. It's most funds like to call themselves things like Lion Rock, so that
Solid.
they're solid. They're never taking a risk with your money. Whereas, certainly in my world, it's the judicious taking of that risk and the being exposed to the right risks that generate returns. The Twitter handle Danger Capital is a bit of a play on that.
So what inspired you to write the book? I saw the Excellent Investing. I was a little bit wary when I saw the title because I like to read value investing books, but it's very clearly it's a value book and you're a deep value guy. So what inspired you to write the book?
Yeah, I've tried to write the book. Although I myself am a deep value investor, I've tried to write the book from a perspective of things that are applicable to lots of different types of investors. Hopefully that comes through, and it's not all deep value, but I guess it's very hard to remove yourself from your lens of the world.
Right.
The book itself is I read a lot of obviously widely around investing, and there's a lot of books that are how to choose your next great stock, and there's very few books that tell you how to build that into a coherent portfolio. And the process of building a portfolio, weighting the stocks in that portfolio, avoiding investment mistakes, in my opinion, are almost equally important as being able to be a stock picker. And I felt that so a lot of investors were sort of under-resourced in this area. And the books that were out there were quite academic. So
Sure.
They either were very detailed and good, but very hard to apply, or had no practical aspects for implementation, or they sort of pushed you towards passive investing. And for a lot of people, I think sort of passive investing is a great thing if you don't have the time or the inclination. But sort of saying to stock pickers, well, you should give up and go into passive investing. The analogy I use, it's a little bit like one of your friends asking for relationship advice to improve their romantic relationship, and you say, "Oh, just break up. You're terrible anyway. Just break up." And it's just not the sort of advice that people want. Or
There might be
or
some
usually
incremental advice before that end stage.
Yes, yeah. There should be something, and hopefully the book is that practical guide for people to build better portfolios, and particularly to avoid sort of common investment mistakes that people make.
I like the way the book is laid out. You begin with strengths, and then you move into weaknesses, and then how to build an optimal portfolio. So let's go through that. The first thing is talking about competitive advantages, and you don't mean that just in terms of finding competitive advantages in the companies that you're looking at. You mean finding those competitive advantages in yourself. So perhaps you'd like to discuss how you go about doing that.
Yeah, I think, again, there's a lot that's written about competitive advantage, finding moats in the market, and they're very important. Being able to analyze a corporate moat is one of the key parts of successful investing. But many people sort of forget to apply that process to themselves or to the managers they choose. So they accept that a company without competitive advantage will, in the long term, only earn its cost of capital, but they forget that, well, actually, you're going to have the same thing. The stock market is a competitive market in the same way, and unless you have an edge, you're gonna, at best, if you're a good decision maker, match the market performance, and at worst, you're going to massively underperform. And I think there's probably two advantages that, or probably only two advantages that individual investors like myself can have. They're smaller companies, the sort of stuff that your average fund can't invest in due to size, and thinking longer term than the market. And that doesn't mean investor has to hold for the long term, but they've got to be willing to do that. And I think there's some structural reasons usually to do with bonus incentive and not being fired, why fund managers can't truly think long term with their portfolios. And finally, I think there's an advantage that all investors can have, and that's this kind of so-called special situations. So you look for places where people are selling that are unrelated to the underlying value of the asset or the business. So spin-offs are the classic example of that.
I think you sell individual investors short a little bit sometimes. Everybody does when, if you can value a company and it's just mispriced in the market, whatever the reason is, I don't think you'd have to worry too much about why you're the one who found it. You just know that over the course of a year, if you find a company trading at, say, $100 at the start of the year, over the course of the year, this is pretty common. They trade as low as $50 and as high as $150. And if you think it's worth somewhere between 80 and 120, then you can buy it at 50 and maybe sell it at 150 or hold on to whatever the case may be. So I do think that individual investors can do this stuff for sure, but there's no question at all that there are going to be some places where that's easier, and that's certainly going to be in small and special situations, as you point out. So that's one of the bits of advice that you give. Think small, and then I interpret from that, or you discuss shortly after that, think about value too. Why focus in those two areas beyond sort of the returns that you can find there?
Yeah, well, I guess just the historic outperformance that value has shown, as well as kind of small caps. I know it's sort of both are a little bit controversial. The kind of small cap effect has been sort of widely criticised, but there's a good paper from Cliff Asness called, let me get this right, Size Matters If You Control Your Junk. I think you're probably aware of it. And his thing is, you do have this size effect as long as you ignore the really, really sort of scummy companies, the promotes, the bankrupt, the some of the IPOs where they're just the founders cashing in. If you just avoid those worst quality companies, this size effect comes back in, and it's more pronounced in value stocks as well. So, or maybe the value, that's probably the wrong way around. The value effect is more pronounced in smaller stocks as well. So if you do have the mindset to be a value investor, I think that, kind of small is the place to be. You still need to be able to analyze a company, but that's the kind of, you're sort of swimming with the flow rather than against it, in my opinion.
It's one of those places, small caps is one of those places where it really does pay to be a stock picker rather than an index hugger, for the reasons that you point out. I also think, even though value has had a horror run, and size has had a horror run to the point that I think now there's a question whether the size effect actually exists or not, which the contrarian in me says, well, that's probably a good place to be hunting right now. You say that folks should think differently What do you mean by that?
Yeah, so what I kind of said in the introduction is that the process of thinking or finding opportunities where somebody else is selling and they don't really care about the price they get. So that's when you're going to find your biggest inefficiencies. Kind of Joel Greenblatt's Spinoffs are the sort of classic one where you get a small business unit that's spun off from a larger company, and then everybody says, "Oh, what's this small amount of stock I've never heard of in my portfolio?" They sort of treat it like a free, like a free bit of money. They're like, "Oh, hey, I can, well, depending on the size, go out for a meal or go on holiday. I just, I'll sell it," and they view it as something that they've got for free and therefore doesn't really have any value.
Right.
Other examples, I think you sometimes see this at year end. You get companies that nobody wants to hold the loser at the year end. And
you got that tax effect too.
Yes. Within the UK, it's a different.
You got a fiscal year end and a tax year end are not the same, right?
So you get it.
So this is a reporting phenomenon. They just don't want to show that they were holding it over the course of the year, right?
Yeah. And if you're going to buy something you think is undervalued, you've just got an incentive to wait a couple of weeks and, put it in your portfolio when it's got a full year or a full quarter to sort of recover and show that, you're the genius that picked the recovery stock. Right. So, and with low liquidity at sort of Christmas time, New Year as well, I think that the whole combination of the three, the tax, the liquidity and the reporting, means you often get price insensitive sellers, which you can take advantage of.
The Spinoffs is interesting because everybody read that Greenblatt's yellow book when that came out, whenever that was, but it's been around for 20 years or something like that, maybe longer than that. Is that right? Something like that.
Yeah, 99, I think.
Is it 99? Well, yeah. Almost literally a little bit over 20 years. And then had a great decade for spins, and everybody made a lot of money, and value guys get to look really smart buying the uglier part of the spin and holding that, or watching, where the managers go, as Joel recommends. But then the last decade's been really rough for spin-offs, so they just haven't worked very well. So I don't know whether it's just the book got too popular or there's something junky about spins, or I'm not really sure. But what do you think about that?
Yeah, I think there's probably a couple of effects. One is just everybody knows about it. So I would certainly expect the speed that people adapt to this would change. So I think in Greenblatt's book, he said you wait 6 to 9 months before buying in. You're waiting for the smaller investors to get bored, see their brokerage statement and kind of sell off. And these days, I mean, most people are sort of checking their portfolios daily, or that
would be a lot of restraint. I check it about 100 times a day.
Yes, so I would definitely think that the effect you're seeing is going to be is going to happen quicker, just because information flows. People are used to the idea that kind of spin-offs are there. I think. As well, what Greenblatt says is you still have to do the valuation work, whereas maybe in the past spin-offs definitely, you could just buy every single one,
right,
and you get some excess return by doing so. I think but he never really said that was the way to do it. He said, well, no, if you do good valuation work, this is the place to be, and that's maybe what people forget, and some of the valuation stuff of the general market could be considered excessive in certain areas. So again, if they're spinning off popular companies at high multiples, do you really know better than those managements or better than those teams? Probably not.
And you talk about merger arb, or as I like to call it, risk arb, because it sounds a lot sexy. You could be danger capital and get a little thing on your card that says that you're a risk arbitrageur. That'd be great to go to the pub and hand those out. Get a lot of that's super sexy.
Yeah.
So merger arb. What are your thoughts there?
So I think these things work, but they're not very good places for your individual investor to be searching in. The same with things like convertible arb or a capital structure arb, where you buy one structure of share and you short the convertible or the bonds or something like that. They're just usually they have the wrong type of exposure you're looking for an investor. So if you win, you win small, and you lose big. If that merger doesn't go through, you lose 30 or 40%, whereas if it goes through, you make 5%.
Right.
And hedge funds really like this because it's uncorrelated to the rest of the market. So if you call them right, you get this small return every time, and like no correlation. And if you invest in 100 of them and you have the resources to do your research well, you'll do quite well out of it. And also if you're prepared to use leverage. But for the average investor or individual investor, you're going to be not have the time to do the right level of research to gauge whether it's going to go through ahead or not. And you're not, the risk reward just doesn't look like the sort of thing you want as a individual investor, which is heads I win several 100% and tails I lose 5%.
I don't mind merge arb as a strategy for home gamers. I think you just need to combine it with a value mindset where if you think about what happens if this busts, I hold whatever I hold. I'm short one and long the other, or not even worry about the short. Just hold the target long. But I also like to do it when if the merger gets busted, or there's some problem with it and it trades really wide, and you think the underlying's undervalued, which often they are. So you can buy them, and then you've got, I've got an undervalued stock which is probably going to work. And then there's a chance that those returns get pulled forward and the deal goes through and you get a pretty material pop. That's worked a few times for me where the professionals have picked them over pretty heavily and don't think it's going to work at all. And because I don't know what I'm doing, I'm going to put in 1 or 2 or 3% in something that I think is undervalued, and then it went through. I'm getting paid for something that I didn't really know how it was going to work.
Yeah, I think if you're willing to hold the underlying for the long term, so there's chances you get competing bidders and more people come in as well. So it's probably the going long that and also shorting the acquirer and taking on significant leverage to make a 5% return into a 50% return that's going to hurt most individual investors. I'm not averse to it if I spot something that I think is underpriced, but it's definitely on the riskier end.
I had Michael Mauboussin on the show, and he said it's one of those, it's sort of this received wisdom. I guess there was data in it too that mergers don't work. They're basically value destroying for the most part. And he said over the last decade that's not actually been true. Mergers have tended to outperform, which just goes to show you how hard this game can be. One of the parts that you the next section that you talk about, know yourself. I kind of love this. So you talk about the different personality types. So can let's talk about that. What are the different personality types?
Yeah. So when I was writing this, one of my key theses is no strategy works, consistently over short periods of time. Everybody at some point will face drawdowns. Everybody will have a strategy that just doesn't work. And the reason is markets are adaptive. So if you had something that worked all the time, everybody realized it. And
that doesn't work.
It gets halved away. So it's suddenly it doesn't work. So it's anything that works for the long term works because it's painful in some way. And that pain is it doesn't work for extended periods of time. And the more you're able to stick with your your strategy through these weak times, the better long-term returns you'll have. I'm sure there's people out there who can sort of read the market. They can, can sort of jump ahead of the trend and do that. But you look at the data, and most people have very poor market timing instincts. They capitulate at the bottom of the market, and they, go all in and leverage at the top of the market, or the top of the market for their particular strategy. So I think most people are better choosing a strategy that they can stick with over the long term, and that's going to be a lot easier if it fits their unique personality.
Sorry, keep going.
Yeah, and I was going to say, one of the I did quite a lot of kind of reading around, trying to look at what academic research was into this personality style, and there wasn't a lot that I personally found particularly useful. And particularly because it tended to use categories of types of investors I've never heard of or never heard anybody else use. And most people, if you ask them what type of investor they are, they say, I'm a trend or a momentum investor, I'm a quality investor, I'm a growth investor, or I'm a value investor. Right. And the reason is they're the styles that have worked, over long periods of time. So what I wanted to do is sort of look at using the sort of big personality. I think there's 5 different measures of personality. Let me get this right: agreeableness, openness, conscientiousness. Oh man, I can't remember the other 2, but the one that I think stands out most for investors is agreeableness, or its opposite, which is disagreeableness. And it's essentially how willing are you to go with the flow of what everybody else is doing. Are you the sort of person that if nobody else is laughing in the cinema, you don't find the film funny? Or are you the sort of person who is roaring in laughter and everybody else is looking at you going, what on earth is this guy on?
Well, that's why they play the laugh track, right? Because I guess most people like to hear other people laughing. That's your cue. Yeah.
It's it's right. People know that most people prefer to go with the flow, and as an investor, if you're somebody who goes with the flow, you're probably much better off being a momentum investor,
right?
And just sort of picking that trend and following that trend. If you're and that's agreeable. Those are the people who are agreeable. But if you're an agreeable person trying to be a deep value investor, it's sort of great with you every day. It'll be difficult for you to go against this flow, and you see the market going this way and you're going the other way. I think with Warren Buffett, everybody says, okay, he transitioned from being a kind of Graham value investor to being now the Warren Buffett quality investor that he is now, because he reached the limits of his, what he could deploy capital into. He met Charlie Munger. He had this kind of epiphany. And when you read like biographies like The Snowball, you see that actually Buffett, he isn't a very disagreeable person.
Interesting.
He wants to be liked. He wants to be popular. He really struggles with I go into this town, everybody hates me, and I'm closing down their factory or sacking half their journalists. It's right. It just doesn't really fit. Certainly, my assessment of his personality from reading those sort of books. So it does seem a very natural transition for him. You can imagine that being the quality investor, the never sell, the working with the management, the thinking long term, building a team, that kind of agreeableness fits much better with his current strategy than it ever did with the Graham liquidate the business strategy.
That's interesting. That's a good insight. I've never heard of that before or thought about that, but there's something in that. This is a digression, but I saw when I was a university student, I went and watched American Psycho in the cinema.
Oh yeah.
And I only went and watched it because the book had been banned in the state when I was growing up, and it had been published.
Oh, right.
And then the movie came out, ridiculous. But I thought that the reason it was banned was because it was such a violent serial killer kind of. That's what I thought it was about. I didn't know it was a dark comedy, and I went into the cinema. It wasn't very popular, and it was in the middle of the day, and there were maybe half a dozen other people in there. And halfway through the first sort of scene, I realized that it was actually a comedy and started laughing really hard, which scared everybody else in the cinema because here's a guy laughing at a serial killer type movie. Anyway, I digress. One of the
it's probably a sign you're disagreeable.
It's probably why I'm a deep value investor.
Why deep value investing?
I think I'm quite an agreeable deep value investor, though. Maybe I got to transition at some stage too. I can't do it. One of the interesting parts in the know yourself. So there are two parts that I really like. You discuss grit, and then let's discuss grit. So what is grit, and why is it important?
So this is a sort of term that psychologists have come up with to describe. I guess people are willing to stick with things despite adversity. And the classic sort of or the class definition sort of has two aspects. The one is persistence, the ability to kind of maintain it, and the other one is interest. So it's and they claim certainly that it's a better predictor of success than conscientiousness. So that's the other one of the big 5 personality types that relates to usually conscientious people are usually highly successful people because they care about the details, they work hard, they are willing to put the hours in, they care about things, they care about success of things. But the claim is that grit is actually more predictive of success than conscientiousness, because it tends to be domain specific as well. You can be gritty in one area and not gritty in another area because there's this enjoyment aspect to it. So I always sort of I guess my advice in the book is if you're an investor, find a strategy that fits your personality, but also find what you enjoy about investing. So if you enjoy going and meeting managements and gaining insight into businesses, you're much more likely to persist and have grit during those periods of underperformance. Whereas if your strategy relies on meeting managements and you really don't like it, you're not likely to have that level of persistence. So it's the sort of two combined that make sort of grit so powerful. It's the persistence aspect, but also the enjoyment of the process that keeps people going.
There's a great Paul Graham essay where he talks about what he looks for in founders is this bus ticket collector. Have you heard this before?
No, I don't think so. Go for it.
Basically, the idea, so bus ticket collector, maybe something like the UK version might be a train spotter. It's someone who just does something that ostensibly from the outside it looks really boring and nobody would do it, but these guys just do it because they really love it. And then if you can find some way to turn your little obsession that you would do anyway for free into a way to get paid enormous amounts of money, then it's complete joy for you every moment that you're doing it, and it's easy for you to persist through times when it doesn't look like you're going to get paid or there's no chance of getting paid. I often think it's like Joe Rogan with his podcast. He could easily be like a guy running a little radio, like a shortwave CB radio station out in Malibu or something like that has an audience of like 100 people. But it just turns out that when you put your little CB radio show on the internet and call it a podcast, you wind up with millions and millions of followers. Again, a little bit off track, but the same idea.
Yeah,
One of the things
I think it's no.
Sorry, keep going.
I was going to say it's a little bit like Ian Castle's Intelligent Fanatics.
Right.
It's like, you want the intelligence, but you like the
need the
fanaticism
fanatic.
as well. Can have real value for businesses and real value for investors if you can find them.
Yeah, I love the other part where you go through each personality type or investment type, and then you say these are the common mistakes that each one makes. So I'd like to go through that. Let's start with value investors. What are the common mistakes that value guys do, or that personality type makes?
So I think with value investors, because they tend to be disagreeable, it can quickly go into stubbornness. There tends to be, you need an overwhelming amount of evidence to say that you're wrong, which means that value investors tend to average down too much.
Right.
So I am an average down investor. I don't see the moment that I buy something, the world should suddenly love it and it should start going up again. It's likely to keep going down because I'm buying something that's already hated. So it's likely to get more hated than it is to turn around. So value investors can be a little bit slow to realize, oh no, actually something has changed, and to switch and say, right, I'm going to sell here. So things like at cost position limits. So the idea that you limit not just how much of your portfolio you'll put into a stock, but how much you'll put in at cost. It is kind of very important for value investors.
So just to expand on that means that if you've got a 5% position at inception and then it halves, and then you re-up to 5%, before you do that, at the start of that process, you should say, I'm prepared to lose no more than whatever it is, 7%, 10%, whatever it is in this particular position. So you can't just keep on doubling up as it goes down.
Yes, because you can quickly lose, you can have a 10% portfolio limit and quickly lose, 10, 20, 30% of your portfolio on that one stock because you keep just putting more and more into it.
Right. John Hampton has a great discussion. John Hampton, the Aussie sort of hedge fund, he's best known for shorts, but he's long short. He has a great discussion on his blog about just that exact, there's this tension between the Paul Tudor Jones losers average losers and the value investors who, really good value investors have made a lot of money. If they're right about the value and it goes down, the opportunity does get better. But you have to have some risk limits, because the first supposition or proposition there is that you've got to be right about the value, and these things can go down and sideways for a lot longer than you can.
Yeah, I think he talks about maybe Bill Miller in that, and I talk about that in my book as well, as obviously a kind of value investor who beat the S&P after costs for 15 years in a row. Right. When they do studies on is success chance or is it not, it always used to be Bill Miller that they picked out as the proof that there was skill, until in 2000 wherever it was in the financial crisis, basically, he lost investors all his cumulative return over those 15 yees. And he did it because he kept averaging down on things like
Kodak,
Washington
right?
Mutual. Yeah, just no, I don't. Yeah, I can't remember whether it's that, but it was a lot of it was all the stuff that was bailed out in the financial crisis, and you kind of think, essentially he was bailed out, and I think he's had a bit of a resurgence in the last few years because obviously he is a guy who knows his stuff, but that process of averaging down on the same leveraged sort of stocks, and I think this is what Hampton says as well, is don't average down if it's leveraged or if there's obsolescence risk like Kodak.
I've even lost money in Washington in the Washington Mutual stub that had a whole lot of net operating losses. I managed to lose money. I didn't lose it beforehand, but I lost it in the stub. So it got everybody, that thing. Jeez. What about momentum investors? Where do they make mistakes?
So I think the momentum investor, probably again, position size can come to haunt them because the stuff that's doing well becomes the their biggest positions, and you have this tendency to kind of to start to like the things that make you money. So they can get caught by, if you're a pure momentum investor, if the momentum fades, you should be selling. But you see a lot of momentum investors, they like the product of the thing. So I've seen people. Do you get Fever-Tree in the US? Do you know what that is?
No. Oh well, I don't. We may have it in the US.
It's a premium tonic water.
Oh yes, sorry, we do. My wife drinks it. She's going to kill me.
And it did really well because it sort of got ahead of this premiumization process or trend. So no longer people didn't want the Schweppes or the whatever the brand is in the US. They started to ask for Fever-Tree. Pubs started to stock it. It became this kind of trend, and it did really, really well. But people also were became, well, I'm also a Fever-Tree drinker of the tonic water. I prefer Fever-Tree, so they're making all this money on the stock and it's going up.
Right.
But they're also going, and I go and buy Fever-Tree and I tweet pictures of me drinking Fever-Tree and, I'm sure there's good investors out there who got out, but the reality is that momentum doesn't last forever, and it's very hard if you've identified as, I am the Fever-Tree investor and drinker of the products, and I met the management maybe, and you kind of bought into the whole environment. It's very hard to then sell. Whereas the day the momentum turns, if you're a momentum investor, you should be out and you should be moving on to the next thing that does have positive momentum.
Is that true? That's true for growth investors as well? Is that the common mistake that growth investors make? Yeah,
I struggle to. It's harder to define a specific personality trait for growth investors. The thing that I found probably most instructive was Henrik Kronqvist, I think is a Swedish academic, did some research on twins. So he looked at how likely are identical and non-identical twins, or what factors did it cause people to prefer growth investing to value investing. And there was definitely a genetic aspect. So if identical twins were more likely to be the same type of investor than non-identical twins, so interestingly, your genetics plays a part. But the other one was people who have higher disposable income, greater social capital, so have better jobs or better careers outside of investing, are more likely to be growth investors, and people who have lived in times of economic boom are more likely to be growth investors. And the common factor I could come up with was they all create optimism.
Right, quite optimistic. So yeah,
it gives you the optimistic thing. And in the book, I talk about the issues with being overly optimistic, and they tend to be that you fall for frauds, fads, and failures.
Right.
So I think that's probably the biggest mistake that growth investors make, is they're just too optimistic about the future, and they particularly have this thing of they will gloss over red flags that say, well, this isn't a particularly strongly financed company, or this management have committed frauds before, or a number of other, or they buy into fads which quickly reverse.
It's very difficult because Ian Castle, who we were talking about before, he's done some analyses on, and this is quite common, looking at how, to hold those multi-bagger compounders over years and years and years, you do have to endure many of these gigantic drawdowns. Like Amazon famously has a 90% drawdown early on, so I'm sure almost nobody has held it from IPO to date because of things like that. But equally, you sort of have to have that ability to recognize when it's maybe got too far ahead of its skis. I honestly don't know what the balancing act, how to do that balancing act. That's why I don't do that. That's why I'm a deep value guy, because it makes sense to me, and that I frankly just cannot figure out how they do it. But I think it's a nice segue into the weaknesses part of the book, where you're discussing the behavioral biases. So let's just start with overconfidence and what is that, and how do we overcome it?
So most of us are overconfident. We believe that we are better at things than we actually are. If you got a room full of people and ask them, hands up if you're a better than average driver in this room, 80% of the hands would go up, I think, is on average. And it's sort of natural to think that to be confident in what you do, particularly if you're experienced and you have kind of specific knowledge and experience. One of the classic studies is, I think, a psychologist got and this is like in the 1950s, so it's been known for a long time, is asked people to do asked other psychologists to do personality assessments on patients, and he gave them, he started off with a bare minimum of information in their file, and then added more and more information, and the more information didn't add any real extra ability for them to assess personality. It's very complex to judge somebody's personality or neurosis or whatever from the information. So I think it started off at 26%, around 26%, and they thought they'd got about maybe 30% right. At the end of the process, when they'd been given all the information, their personality assessments had not improved in the accuracy at all, but they thought they were 50%, 50% confident in what they'd done. So all the extra information had done, and I think this is a real problem for investors, because we tend to think, okay, the more research I do, the higher conviction I can have in that position. The more times I've met the management, the sort of I can go to 20 or 30% rather than my normal 10%. And you add all this information, and in reality, your judgment about the stock has not got any better. You've just become more and more confident in your own assessment. And then, something that was completely left field. Imagine, take BP and the Macondo well disaster.
Right.
How many people foresaw that a single well blowout was going to cost them $62 billion in fines and compensation?
Is that what it came to finally?
Yeah, that was the final figure.
I had no idea it got as high as that. Wow.
If it wasn't a super major, it would have put the company under. Basically, any other company would have, apart from Exxon or Shell, probably would have gone under for that.
That's amazing.
That level of damage.
I was investing through that period, and I remember that it sold off very sharply. And Whitney Tilson went on television and said it's overdone. That they won't be as big as this. And I thought that's probably right. Like, everybody does overestimate the scale of the crisis in the moment. But I had no idea that the final bill was $62 billion. That maybe everybody panicked appropriately.
Yes, yeah. Except I guess the company.
It survived.
The company did all right and survived, and kind of made the returns back. So even though it cost that much money, you look at the long-term chart and it hasn't really caused the damage you expect. But that is $62 billion that's gone out of shareholders' pockets and been returned as dividends or something.
In Quantitative Value, we discussed two studies that are similar to the one that you discussed there. One is on horse race predictions, and another one is on college football. So they asked some college students about college football, if they knew anything about it at all, and they said that they did. And then they had, say, 100 pieces of information, and they randomized those pieces of information, and they gave them 10 blocks of 10 bits of information about the games. And so you got the first bit, and you made your prediction on who was going to win. And then you got the second bit, and then you made a new prediction, but the person sitting to the left and right of you might get different information, even though by the end you all had the same information, and people made different predictions. And I think that the conclusion was that we anchor too much on the first bit of information that we get. So your decision was sort of made on the first block, and then everything after that was just you collecting for your I am right file to show that the decision was correct. I think that so we don't update our priors enough. And you talk a little bit about Bayesian probability in the book. I don't know if it's in this context, but that was the question I was going to ask you about the value investors. Is that a good approach for value investors, do you think, to sort of take some sort of Bayesian approach where if your instinct is to get stuck into something and to dollar cost average down into it, in the case where you're wrong, you're finding this new information, you got some probability, here's your new bit of information, now you update it with your pride, have some process. So if you get enough of these, eventually you've got some statistical reason for selling out of something.
Yeah, I think it's good if you can actually quantify those things. I think if you can do that, that's great. But I think for the vast majority of investors, that's probably too complex a process to apply, or it's certainly to actually apply the formula. I think with the Bayesian approach is there's two factors that you really need to be aware of. The first is base rates matter.
Right.
So if you are going to invest in IPOs, then knowing that the average IPO underperforms in the following 12 months, it is an important base rate.
Right.
And if you bought two successful IPOs and they did really well, your tendency is to forget the base rate that will actually most management's IPO at the top.
Right.
They're the most knowledgeable people and they're the most willing sellers. So therefore, and there is exceptions to that. I think you get IPOs where management don't take any money out and it's all the money goes back into the company to grow. But the average, particularly private equity sellers and things like that, they're the knowledgeable investor and you're the patsy usually in those situations.
They do a big recapitalization and pay themselves a big fat dividend, load the company up with debt and then IPO it. That's the one you got to be careful of.
Yeah. And then it goes bust 5 years later and they buy it off the administrator and then it comes back into the market a few years later.
That's a great trick.
And then false positives are the other one, is the idea that if you have an idea of what not just you have some signal that says this is a good buy, it doesn't just matter, how often that signals that it's a good buy and it is a good buy. It also matters that the times it signals and it isn't a good buy.
Right.
And having an idea of the sort of false positive rate as well as the base rates gives you it's very important in medicine and diagnostic tests, having a high false positive rate, for something like coronavirus really isn't a good test, because if you test thousands and thousands of people, you're going to get a lot of false positives and those will dwarf the real cases of coronavirus. And now you've got thousands and thousands of people in isolation or in hospital who don't have the coronavirus and taking up beds for people who are genuinely sick. So in medicine, false positives are a real challenge, particularly when you get big screening of lots of people.
What's loss aversion?
So loss aversion is a case where we just don't like to take losses. And you see this in people's portfolios usually by a long tail of small positions that people just aren't willing to sell.
Right.
And everybody is loss averse. I don't think there's anybody out there who's truly sort of calibrated to not mind taking a loss. And the strategies that people kind of use to deal with this. In the book, I suggest that everybody should have a lower portfolio limit. So everybody should just say, if this drops below, say, 1% of my portfolio, I'm just going to sell. And I've applied this to my own portfolio, and it's really hard.
Yeah.
It's like, other people have stop losses. So, they say, well, okay, if something drops 20%, I sell out, and that's a kind of stop loss. So I don't think that usually works very well for value investors.
It's statistically not well supported on an individual stock name, and I don't think it works for value investors too. I agree.
So for me, so some people, this is never an issue because they buy something, it goes down 20%, they sell, it's gone. But for me as a sort of value investor, I either average down or in the ideal world, I either sell. I should be selling or averaging down. But what you find is you get these positions that you go, oh, I'm not confident enough really to put any fresh capital in,
right.
but I also don't want to sell it. And it's a classic sign of I'm loss averse. I don't want to take a definite loss. And we tend to sort of roll the dice. We like to kind of say, rather than taking a definite loss, I'll roll the dice and hope something works out. But of course, if something's 0.2, 0.3% of my portfolio, it could double.
Yeah, it's irrelevant.
It's daily noise. So why am I still holding this? Why am I spending my time and my energy to actually do this? And I either say, right, I've got to, this really is my best idea, and I'm going to buy more, or this is this is loss aversion. I'm just going to sell and cut it out.
Do you know, that's funny. I'd never heard that idea before of a lower position limit. But about 2 weeks ago, Jake Taylor on our other podcast that I do with those two guys, he mentioned the same idea. I think it's a really good idea. I don't know if there's any statistical support for it, but it's a good one. Good behaviourally.
Yes. I think I know where Jake got that idea from.
Where did he get it? Did it come from
Me.
the book?
Yeah.
There you go.
My book.
Congrats.
Because I went on his podcast, and it's one of the things
there we go. That's great. That's what you got to be careful, man, because ideas come back at you from lots of different angles, even though there's only one source. I was just like, I've heard that idea twice. It must be a good one.
So I can now quote that I've heard it on your podcast and Jake's podcast, so therefore there's some evidence for
it. Optimism bias. What's that?
So I think this is a more general case of sort of overconfidence. So overconfidence is I am too optimistic about my own abilities and the things that I can control. Whereas optimism bias is we just tend to be overly optimistic about everything. We think that the product of a company will be bigger than it is. We'll underestimate the amount of time it will take to develop and the amount of money it will take to market. We're just and it's for good reason. If you're an optimist, you're typically more successful, more attractive, more, there's lots of sort of biological and...
It's pushed humanity forward for hundreds of thousands of years.
Yeah, the guys who weren't willing to leave their caves because they were scared. So I think the only people who aren't overconfident are the clinically depressed.
Right.
You don't want to kind of trade that off.
They're accurately assessing the risks.
Yes.
We should listen to them more.
Yeah. So if you want probably if you want a risk manager, get a clinically depressed risk manager to.
You got to be careful of the flamboyant risk managers.
Yeah.
I had a thought when you were talking before about the overconfidence bias. Did you? I don't know if you have any discussion of Dunning-Kruger in the book, but the Dunning-Kruger. Well, do you have a discussion?
Yeah.
What's Dunning-Kruger? Let's talk about Dunning-Kruger.
I briefly mention it, I think, because so for those who don't know, Dunning-Kruger is this idea that the skills required to assess competency are the same as the skills of competency themselves.
Right.
So the truly incompetent are doubly cursed because they're both truly incompetent and unable to see their own incompetence.
Right.
So it's why you get, the guy in the office who everybody thinks is terrible, but he thinks he's the best, the best performer, the highest guy, that everybody loves him. So it can be sort of quite annoying, in a kind of work context, but as a sort of portfolio context, it really is that thing. And I think I talk about it in relation to some of the some of these behavioral biases. My theory is that you're much better off making rules for your portfolio, like a maximum portfolio limit, a minimum portfolio limit, than you are leaving it to your discretion.
Yeah.
And the reason is Daniel Kahneman, who won the Nobel Prize for all of his research in this area, they asked him, has it improved your decision making? And he said, no, it's just made me better at spotting the mistakes in other people.
Right. It's funny, isn't it? I think that Dunning-Kruger also impacts, there's that when you learn a new skill, initially you think, well, this is quite easy. And then a little bit later you think, no, this is insurmountably hard and I'm terrible at it and there's no hope. And then you gradually so you're just overcoming that part where you don't know how bad you are. Then you do know how bad you are, and then you start getting better. Yeah.
I think that probably mirrors a lot of people's investing journeys, because I've got a sort of mathematical background. So when I first started investing, I could do the discount cash flows, I could do the that kind of stuff, but so I do discount cash flows for things, and then of course something from left field that I hadn't seen at all would completely wipe out the company, and you look back at the sort of files you created, these complex models, and you just like, what was I thinking? I missed the wood for the trees.
Right.
And I think it's that sort of effect that you go through this investing of, oh hey, I can do it, I can read Ben Graham and analyze a balance sheet or do a discount cash flow, and then you go through the process of, oh no, it's not enough to only know, to be good, I have to be better than everybody else. I need an edge. And then you go through the process of, making all these mistakes and trying to overcome those by trying harder. And as I found it just doesn't work. You need the rule, you need the the process.
I couldn't agree more.
Place.
I agree with all of that, and I think that I'm like Daniel Kahneman. Like I suffer probably more so to all of those things than everybody else, and so it helps to have the rules there. And I was just thinking before about the loss aversion. I'm thinking of the particular stock in my portfolio that I'm dreading selling, but I know that I'm going to have to rebalance it out at some stage. I don't want to mention it because I don't want to give it too much more heat. There's
Just do it. Rip the Band-Aid off.
It's out of my hands. I don't have any. I've already handed that over to the system, so I don't have it. I don't get to make that decision anymore. Thank God. Otherwise, I'd still be. I'd hold it. That's my instinct is to hold it. I like that in the optimism bias context, you talk about fads, frauds, and failures. So let's talk about how do you avoid fads?
So fads. This might be controversial, but I don't think you should necessarily avoid fads. Fads can be very profitable on the way up. The way to spot them, they can be quite hard to spot, but I think there's a couple of clues. The first one is single product companies. Mm-hmm. So I think I used the example of Crocs in the.
That's what I was thinking of.
And maybe
they're coming back.
Yeah, they come back in, and it's like you think,
they're a net at one stage. You could have got them as a net.
Oh, really?
Yeah.
But when you've got one product, you are massively exposed to these sort of trends, and also your advertising isn't as effective. Whereas if you take a kind of luxury goods company, you advertise Burberry, and they could sell shoes or they could sell ties. Anything that fits that brand can sell well and the advertising adds value. Whereas Crocs, it's like you either want a pair of Crocs or you don't. And for a long time people wanted them. For a long time people don't. And
people felt very strongly about them both ways. That's right.
I picked that because people have a sort of almost emotional reaction to whether they like them or not.
Burberry had. I have been to the UK a few times, and the last time I was there, Burberry had a problem where the chavs were there was like this.
Yes, yeah.
Just explain to everybody what a chav is and what the problem was.
So the sort of I guess the kind of classic definition of a chav would be somebody who is from a relatively poor background, who probably has money to spend on kind
very
of
delicately
goods.
Done. You diffused that bomb very well.
But they're probably not as discerning, or they don't have the background that somebody who has always purchased luxury goods has. So it tends to be, it tends to be an insult, really. It's something used for somebody who, kind of wears a certain style of clothing. And this is the issue Burberry had, was they had a very unique kind of check pattern that defined their clothes. And then people of this demographic started wearing it. So then people of their more classic demographic stopped wearing it. But I think because they weren't a single product company, they were okay because they still sort of had the brand. They just had to lose the check pattern on everything. It was the check pattern that stood as being, you can think maybe Canada Goose might be an example of a fad that has now maybe become too popular that now people love to hate it rather than actually love it. It sort of represents people who are showy and have, however much it is, $500 to spend on a winter jacket that they only wear in the city. Sorry.
I think there's 700 or 800. I've been short Canada Goose for a few quarters now, in full disclosure, so I'm 100% in agreement.
There's me. There's the deep value investor who's never going to spend $800 on a coat.
No, I can't do it either. And I live in California, so there's no need. But I still see them around, which just makes no sense at all.
Yeah. Which is because people are using them as a kind of status symbol. And once people turn against that sort of status symbol, the fad quickly ends, in my opinion. I guess we'll see whether your short is successful or not.
It's working, but I'm always nervous about the shorts that can always blow up in your face. I like, in the discussion on frauds, you talk about Benford's Law, which is one of my favorite ways of identifying something that are a bit weird. And I think you could have applied it to the DNC primary over here. That doesn't need to concern you, but I think I looked at the results, just eyeballing the results, and I thought that's a really weird distribution. And I bet if I applied Benford's Law to that, I would find that someone had fiddled those results. But what is it?
Oh, really? So Benford's Law is this chap called Benford found that any series of numbers produced by a natural process tend to follow a certain distribution. So the number 1 is the most common digit, followed by 2, sort of going down through the numerals. So if you have if you do a science experiment or you produce a set of accounts that are made up of lots of small accounting entries over the year, the numbers that are produced should follow Benford's Law. So 1 should be the most
common,
most common number, and kind of down. So if you've made up a set of accounts, so this is not your sort of your earnings manipulation, but your guys who've just completely made up the numbers, people tend to think that certain numbers are more random than others.
Threes
like
and sevens,
a 3 and
right?
a 7.
Right.
It's like, and I know they're not, but I still have this thick feeling that
Well, it's because they're not even numbers. So even numbers don't feel random, and they're not the 1 or the 10, which are both the ends of the distribution. It's not 5 because that's the middle, so that only leaves you with threes and sevens.
Yeah, and it's like if you ask somebody to pick a random number between 0 and 100, people pick 37 or 73 because they feel
that's the most random number.
Yeah, they're the most random numbers because they're prime numbers. They're it's.
Do you think that they know that they're prime off the top of their head?
Well, yeah, maybe they just feel it, but there's definitely that aspect. And the other aspect that people don't like when making up accounts is they don't like to put a 0 on the end. Mm-hmm. Feels too precise. Mm-hmm. It feels like if you made exact numbers, you are trying to show that you've made the exact numbers, so therefore people are going to say, well, you just made up that number. So they underuse the 0 as a trailing digit. It's a sort of, second level thinking thing that catches people out as well. That's
fascinating. And in terms of identifying failures, what do you recommend there?
So, I mean, for me, it's pretty much balance sheet strength. So, all the evidence of this stuff is found on the balance sheet. So the classic one is just to look at the current ratio or the quick ratio. I like there's a guy called Paul Allen who's a sort of accounting professor and wrote a book called Choose Stocks Wisely. Again, a deep value guy, and he sort of takes an adjusted current account ratio. So he takes all the current assets and apart from cash and says, I'm going to take 0.8 of those. He's sort of giving a sort of fire sale or a sort of
that's the Graham discounted net current asset value type approach.
Yeah. Except he's using it for just testing of balance sheet strength rather than
right.
His theory is you want a company that's strongly capitalized in the short term that they can survive the turnaround and the effect of so I think that's a sort of classic one. You then go into the more sort of metrics that people have produced. I think the Altman Z is the classic one that and they all and then that's been updated. I think Merton, of Black-Scholes Merton fame, used kind of treated the equity as an option on the assets or something like that, and he came up with a formula as well. And kind of various people like Olson and then Campbell. I'm going to get this wrong. Hilscher and Svengali or something like that. Sort of, I think, produced the latest one, and they all either have a threshold. You want and the easiest thing is you get these from a data provider. Whatever you use to screen your stocks or whatever, you use those. I think what did you use in quantitative value? Was it Olson?
We used a few. What we found was kind of interesting. At a universe level, excluding the 5% that are the worst on Olson's, Altman, and I think we might have used some earnings manipulation type measures as well. So we used to stress earnings manipulation, statistical fraud, and I still do this because I do think this is a good approach. If you exclude those stocks from the universe, you get a couple of % of better performance out of the entire universe. The funny thing is that it doesn't really... If you're already a value guy and you're looking for these cash-rich balance sheets and strong earnings, you don't really find yourself excluding very many companies from that list because you're already looking for those better quality things. But there's definitely... I still do it as a step just in case something slides through into there. And the other thing I always look for is just a divergence between the reported earnings and the cash flow. The accrual that builds over time is a pretty good indicator that there's some shenanigans, because you don't really necessarily, you rarely find earnings manipulation or fraud in a company that's going really well, because they don't need to do it. So that all of that stuff turns up in distress.
Yeah, interesting you say that though. But the Benny-ish, like there's certain factors that so he splits it into two. He looks at what type of companies are likely to be earnings manipulators, and then he looks at, well, what are the signs of earnings manipulation? So obviously the signs of the earnings manipulation are the increasing accruals, kind of some of those other sort of balance sheet entries, but the sort of things that that the type of companies actually tend to be the fast growing ones,
right?
So because and there's an interesting theory on this from a guy called Dan Davies, who wrote a book called Lying for Money, which is sort of about the types of frauds you get. And his theory is, if you've got a fraud, you've got almost like two sets of books. You've got the real set of books, and you've got the fake set of books, and both have to grow. So you've got sort of two things that are compounding. So anything that grows unusually rapidly, right, you have to investigate. It can be the distressed companies that have an incentive, and obviously going to miss banking covenants or declining gross margin and things like that are all. I think declining gross margin is one of the Benny-ish tests as well. Those things are in there, but interestingly, rapid growth is one of the that's it. That is interesting. The signs.
That's funny that John Hampton pointed this out to me a long time ago, that one of the things that you look for is an unusually large asset that just shouldn't be there. So Parmalat, which was the milk company that went under, they had $1 billion in cash, so they said, in this bank.
Yeah.
And the auditor sent the junior audit employee to the bank to get the letter. The bank said, yeah, they've got the $1 billion here, but the bank was in on the fraud too, which just shows how hard it is to prove it. And the reason they asked was because they were missing some debt payments on the other. Like, why do you have $1 billion over here and you're not paying your debt over here?
That was a classic in the example. One of the examples given in the book of a UK company called Globo, is that they claimed they had 100 million euros of cash and 50 million euros of debt, and they were trying to raise a bond at a US dominated bond at 10% yield or something like that. And it's like, there's something, it was clear there was something going on there. Yeah.
It's funny, as we're talking about this, Tesla, so Musk has said on the last earnings call that they don't need any capital, and they've just raised $2 billion, or they say they're about to raise $2 billion in capital.
Well, with the price, he's stupid if he isn't.
Well, that's right. That's right.
It's like, why, it's like, if you're going to, I'm going to be careful what I say here, but if you're going to keep the game going, then, you need capital, and, you've got to raise it when
they're also potentially perfectly innocent excuses too. Like, when the stock price is high, I'm going to raise capital. That's if I was running that business, that's what I'd be doing. When the stock price is low, I'm going to buy back stock. We're coming right up on time, but I just want to discuss, you've got, just really quickly, optimal portfolios, creating and maintaining. I know that's a big chunk of the book, but just give us a flavor of what's in there.
So I mean, there's obviously the how you weight stocks in your portfolio is one of the big the big questions that most advanced investors face, and I'm going to be slightly controversial because I think you equal weight. Is that right?
I do for ease, but equal. But go.
So I'm so I have an issue with sort of equal weight investing. Is I think it's fine if you hold 100, 200 stocks. You're a bit more of a quant investor with a little bit of additional checks and things like that, because you're not really saying, or if you buy 50 stocks with discount tangible book, you can't really say that this company on 0.3 is better than this company on 0.4.
Right.
So I sort of, in those situations, I get that probably equal weighting is is better. But people who have sort of 20, 30, 40 stock portfolios, when you're equal weighting, you're so sure about what is in that portfolio. You've looked at the universe of stocks and you've said, these 20 are in, and and these however many thousand are out, but I have no idea which of these 20 is any better or worse than the others. So
you advocate for Kelly in that kind of scenario, or some loose Kelly.
Yeah, if you can apply some kind of additional weighting, you will do better. If you can say, okay, this is a better idea. And the other one is that people often forget, and the idea of Kelly is that you weight in proportion to your edge divided by your odds, and the more upside you have, the higher position you hold. And I think a lot of investors naturally sort of think that way. What they often forget is the higher risk this stock is, the less you should hold.
Right.
So I favor using the two functions together, and I don't think, unless you're a sort of quantitative hedge fund, you probably shouldn't be using the actual formula to guide your positions.
Kelly's the outer limit of how much you should put into a position.
Yes.
And anything under that fractional Kelly is perfectly fine.
And knowing that you're overconfident as well means that you're much more likely to overbet, which gives you significant risk of wipeout with Kelly.
Right.
So what I advocate is people put them, have large positions which are in stocks that they consider low risk and high reward or high upside, and then they and these are the sort of the Dando investors. This is Monish Pabrai's kind of idea that you pick the high reward, low risk stocks. Where I differ from Pabrai is, and he spends a lot of time in cash, if I remember correctly, because he can't find these sort of stocks. Whereas I advocate, yes, you can own a company that's high risk and high reward, but you only have a small amount of your portfolio
right
in that position. And that's what Kelly says.
It's also true to Kelly,
Yeah, Kelly doesn't say don't invest in these things. And I know kind of Pabrai uses Kelly in that, but he sort of sticks at and then he equal weights within his portfolio, which again sort of says, he's so certain that these 10 stocks are in, and so uncertain that anything that drops off is not in. I think this is, for most investors, this will be a way that adds value, is easy to implement, and should increase, your risk-adjusted returns if you have the ability to assess risk and potential return.
I think it's a pretty well accepted marker that an investor has skill, that their own portfolio outperforms the equal weight version of the portfolio. So Carlisle famously has a portfolio that outperforms the equal weight version of his own portfolio.
Right.
Just the counter argument, because I feel like I should defend myself a little bit.
Yeah, go for it.
If your universe is 1,500 stocks and you're holding 30 long, you're already down to you're down to 0.2% of the universe. And so then at that level, and this is Joel Greenblatt saying it, he just says it's very hard to distinguish sometimes between those stocks. You may have some false precision in there. And there's a great rejoinder. So Ed Thorpe's son went to a value investing congress in Pasadena and heard Pabrai giving a talk and said everybody at this conference is now a value investor and they're all using Kelly. And so Ed Thorpe wrote this mathematical proof showing why you shouldn't use Kelly, or why you should be. Sorry, I take that back. He's not saying don't use Kelly. He's saying basically size down your positions if you're using Kelly. And he says it doesn't account for black swans. And the other thing that Kelly does, it's used in series when you're playing blackjack rather than in parallel where you have all of the positions in. So you could potentially have a position that should be 51% of your portfolio. And if you have two positions at the same time, that would be 51%, and both go to zero, that would violate Kelly's never risk ruin sort of dictum. So he says find, if you were being honest about the construction of that portfolio, you'd find every positive expectation bet in the universe, which might include gilts, might include treasuries. And then if you look at them all and you size them all down appropriately so that nothing in the portfolio risks ruin, then that should be the sizing that you should adopt in your own portfolio. And so I think if you do that, it still falls out. I found, it's computationally difficult to do, but you can go through this sort of process and you can see that the position sizes tend to be a lot smaller than everybody expects, and it falls out around, like, for a pretty high conviction position, around 3 or 4%, which is how I run my portfolio. Anyway, that's the way it goes.
Yeah, I would say that my caution there is I'm combining this with portfolio limits that reflect that people are overconfident. So, and those black swan things. So again, even the things I think are very low risk and very high reward, in my own portfolio, I'm limiting to maybe say 10%. I'm not going, and I think that's
not Buffett style at 40% of the portfolio.
No. and I think, I think I give the example of in the book that I think even Buffett was overconfident. Yeah. I think with the Dempster Mill, where he had sort of maybe 30% of his portfolio, he later said, hiring Harry Bottle, the manager that turned it round, that changed the course of his life. And I don't really want to be in a position where any one stock or any one investment decision changes the course of my life, potentially at least for the worst.
Yeah, that's a great sentiment to end on, Mark. If folks are looking for a way to get in contact with you, how do they do that?
Yeah, so I'm on Twitter at Danger Capital, or people can email me, mark@excellentinvesting.org.
And the name of the book is Excellent Investing: How to Build a Winning Portfolio. That's the book that Mark very kindly sent through to me, and I enjoyed it a great deal. Thoroughly recommend it. Mark Simpson, thank you very much.
Thanks, Toby. It's been a pleasure.